week on Thursday. This is one of the most comprehensive finance bills that we have seen in a long time. It has about 84 sections, very comprehensive. So what we realize is that there are various thematic themes, that are coming out of the finance bill, about 3 of them which we are going to be discussing this morning. The first theme is around broadening of the tax base. We have seen introduction of new taxes. We've seen the first one is around the digital content creators. They're now going to be subject to tax at the rate of 15%, and my colleague Titus is going to be giving us more information on this. We've also seen the introduction of a digital asset tax at the rate of 3%, and we've seen the expansion of the scope of capital gains tax. So you recall that earlier this year, effective 1st of January this year, the rate of capital gains tax moved from 5% to 15%. Now in the finance bill, there are proposals to expand the scope of capital gains tax. So currently, capital gains tax is only applicable where shareholders hold a company resident here in Kenya directly, but now we are introducing, or rather the finance bill is proposing to introduce, indirect holding of shares here in Kenya. So that means that for the offshore shareholders who hold companies indirectly, they will be subject to capital gains tax in Kenya. From a cash flow management perspective, we have now seen the proposal to pay taxes within 24 hours, or in some instances within 3 days. This might be administratively very cumbersome for taxpayers, and this is one of the proposals that we probably would need to review together with the members of parliament to see whether 24 hours is ideal. This is coming at the back of the betting sector that has been paying taxes within 24 hours. But for the betting sector, their system or their platforms are actually integrated to the Revenue Authority. So it's a lot easier for them to be able to pay these taxes within 24 hours. For the rest of the taxpayers, this is administratively cumbersome because taxpayers also have their internal governance structures, and it might not be possible to pay taxes within 24 hours or within 3 days. The last option, or the last proposal we've seen around cash flow management is an introduction of a tax amnesty covering penalties and interests that are currently sitting on the iTax platform, which is KRA's platform. So the proposal reads that if you have any liabilities and you've already paid the principal tax, which accrued on or before 31st of December 2022, then you can apply for amnesty for the penalties and interest so that these can be cleaned up from your ledger. There are instances where taxpayers would have penalties and interest in their ledgers. One would be, it could either be erroneous, or it could be where a taxpayer made the payments late and therefore their late payment penalties and interest. Or it could also be where you have you already paid the principal tax and you have applied for waiver of penalties and interest, and you're waiting for the verdict from the National Treasury through the Revenue Authority. So in cases where the principal tax is not yet paid, you can enter, as a taxpayer, you can enter into arrangements with the Revenue Authority to make sure that you pay this tax by 30th of June 2024 and therefore benefit from the tax amnesty. I'll stop there and invite my colleague.
As opposed to some of the taxes that Titus, Shreya have touched on, which would either be taxes on gains or certain profits, including, say, your own compensation from a salary perspective. So one of the things that we've seen is then a government that has, placed emphasis on the place that indirect taxes are playing in our revenue collection. So I'll touch on value-added tax, excise duty, as well as other miscellaneous levies and taxes. So collectively, these are starting to play to the tune of in excess of 40% of the revenues that we expect the Kenya Revenue Authority to collect. So if you think about it, one of the challenges that indirect taxes have is that they are viewed to be regressive. They don't make a distinction between your ability to pay and the tax that is actually being levied. So for instance, if I increase, say, VAT on fuel, which is being proposed, it doesn't matter whether I'm a boda rider or whether I'm paying for that petrol as a boda rider, or whether I'm the owner of a fuel guzzler. The rate of the 16% applies across the board. And you can apply that to the other indirect taxes, including excess duty on your airtime or on data. So the taxes tend to be regressive, but our government, including our own, favor them because they are easier to collect. So if you think about it, the VAT that you're paying, say on your airtime to a Safaricom, it's a tax on you as an individual, but it's then taxed on Safaricom to collect and pay over to the government, and that's how come the governments then favor indirect taxes. The other aspect that I wanted to touch on before I get into the detail is you'll have noticed we did not have changes coming through from a customs duty perspective. And one would sit back and say, hold on, we are a net importer as a country. How come we're not seeing anything coming through, from the core customs duty? And perhaps an area that we should be focusing more attention, similar to what we are doing with the bill, because we are part of a customs union, which is the East African customs community. And therefore, what we expect is that later on in the year, in June, we'll get an EAC Gazette, which will bring in the changes that we expect from a customs duty perspective. And that's how come, despite the fact that customs duty, and if you talk, say, to manufacturers, is at the heart of the manufacturing value chain. But it's not really being talked about as far as the finance bill is concerned. So getting right into it, from a VAT perspective, I think we've seen a government that is really bold in some of the moves or proposed changes that are expected to come through. And I start off with the one to do with just a VAT on petroleum products. So this is not new. So we've been paying VAT at the rate of 8%. What is being proposed is that effective 1 July this year, we'll pay VAT at the rate of 16%. I think VAT on petroleum products has always been the intention of the government. So we went through a process that we got a new VAT Act in 2013. Yeah, so you can play it back. In 2013, 10 years later, is when we are getting to where we are then going to be able to levy VAT at 16%. What did we do? When we introduced the VAT Act of 2013, the collection of VAT on petroleum products was suspended. In essence, introduced in the law, but under exemption for a transitional period. So that transitional period kept on being extended up until sometime in 2019, where it could not be extended further. And if anything, you can remember maybe some debate and outcry in 2019 when the government, for the first time, tried to lift that suspension. So as a halfway, the government then agreed to implement VAT at the rate of 8%. Now, I believe the current government or government of the day is a bit bolder. They then decided, you know what, we're going the whole 16% as opposed to the reduced rate of the 8%. Like I said, these taxes tend to be regressive. It doesn't matter whether you're a border rider or somebody who's using the petroleum product from a manufacturing value chain. So you can expect the cost of living, whether in the form of just basic transportation services as well as other production costs, then going to be increasing because of this change. The other one, even as we're talking about VAT on petroleum products, the one product that seems to have enjoyed favor with the government is liquefied petroleum gas, LPG, which we use commonly in our household for cooking. So that was also subject to the 8% VAT. Government is proposing to scrap the 8% VAT on LPG, which is a good thing, because we then expect that cost reduction is going to be passed on to the consumer. Alongside the VAT, the government is also proposing to forgo the excess duty that it collects on LPG, is also proposing to collect a little less in terms of the import declaration fees, as well as the railway development levy that is collected on this product. So net-net, you can expect a significant reduction if the importers of this product actually then do pass on that cost to the end consumer. The other one that has been quite contentious over the last 1 year is around the export of services. We've positioned ourselves as a country, as a hub, to provide services that are then consumed in other parts of our region. And the one change that came into the law last year in 2022 was that the export of service, which traditionally has been either exempt or zero rated from a VAT perspective, was ring-fenced to services that qualified as a business process outsourced service, or BPO. The law did not go into detail to explain what a BPO was. So it has been the subject of a lot of debate over the last 1 year, whether my services actually qualify as business process outsourced services. As a PwC, most of the services we offer to our non-resident clients, we've had to be charging VAT at the rate of 16% over the last 1 year. Now, the change is good in the sense that we are then going to where the government is saying, hold on, let's scrap this complication. We're just going to make export of services exempt from VAT. So exempt always sounds good, but exempt comes with a hidden cost, because remember, the business that is actually providing these exempted services is not able to recover any VAT that they've incurred as part of as a credit. In essence, if you picture a PwC, we have, say, commercial rent which we pay, we have telephony charges which we pay, there's various other service providers that we pay who charge us VAT. When we are not able to recover that VAT, what a good business person does is that you factor that into your cost of sales. So you'd expect that the best outcome would have been where we end up with a zero rating, which says the services remain subject to VAT, but at the rate of zero. On the flip side, then the supplier of these services is then able to claim a credit of any VAT that they incur. In essence, there would be no justification then for factoring this VAT into part of your cost of sales. And so the other one that we've seen is with the compensation that is received from the loss of taxable goods. So if you receive compensation from an insurance company, for instance, what the law is saying is that they want a share of that as VAT. So this, to me, or to us, runs contrary to what VAT is levied on, because VAT is levied on the supply of goods or services. So when I'm receiving compensation from an insurance company, what goods or services have has the insurance company paid, has the insurance company delivered to me, or the vice versa? So where is VAT coming in this value chain? But in essence, the government is then saying, remember, when you bought that asset, I mean, my example, say a computer, you are charged VAT at the rate of 16%. You're now saying that computer which you bought for your business is lost, and you're getting money for it. It's almost the government is deeming you to have actually sold that computer, and therefore trying to hive off part of what you get as compensation as part of the VAT collections. I don't know whether there is any business that is in the business of losing assets for purposes of getting a compensation from government, but in essence that is what the change is targeted at. A change that I guess has drawn some reactions is one to do with flour, maize flour, wheat flour. I think a bit of cleanup in the legislation where it is now quite clear that the supply of wheat flour, maize flour is subject to VAT at the rate of zero. And this is a good thing for us because, like I said, when you supply goods at the rate of zero, you are entitled to your credits. Therefore, you do not need to pass that cost to the end consumer. And hopefully, in aligning to what the government is proposing, that they're going to get the prices of unga lower, that this kind of a change then is a welcome change. From an excise duty perspective, I guess over the years, we've expected, changes around excise duty on what are viewed to be sin products, alcoholic products, tobacco products. We are not seeing that coming through in the current finance bill. And that is because the Commissioner for KRA had discretion to raise the rate of duty on certain products which are subject to what we call specific rate of duty. And there is where we find your tobacco, your alcoholic products, and others including cosmetics. So that discretion that the Commissioner has had is being taken away from the Commissioner, effective 1 July, and we've seen these kind of changes come in October. So this bill is not unique vis-a-vis the other bills we've seen in the recent years. They have not touched on those products because the Commissioner always had that power later on in the year to actually effect those changes through a government gazette. Now that power is being taken away from the Commissioner. So excise duties can only now be changed through a piece of legislation like the Finance Bill, the Finance Act that we are seeing. But the Cabinet Secretary responsible for National Treasury still retains certain power to increase duty rates, excise duty, I mean. So if anything, we wait to see whether there's going to be a surprise through that power that is actually given to the Cabinet Secretary. but then that is subject to ratification by the National Assembly. Another area that has, I guess, faced, I would say, the government's brunt is gaming and betting. I think Titus did touch on this. We're seeing this as a sector that is getting a lot of attention, even from an indirect tax perspective. So from excise duty perspective, I think this is the most significant jump in tax that I've seen through the whole bill. I could be wrong. But we're proposing to move from 7.5% of the amount wagered to about 20%. So you're almost increasing taxes by about the rate of 150%. So what happens? You expect that maybe, you know, is this going to curtail the gaming betting, or is it just going to cause the trade or the practice to actually go underground, especially in the current age where we have a lot of technology available to gamers and the likes. But yeah, so a major change ties again to the whole pursuit by government to collect taxes within 24 hours. At least this one I would commend them, because what they've done is legalize something they've been doing. So Edna did touch on the fact that betting companies have already been paying taxes on a daily basis. We've challenged this because it was not backed by law. So we are now seeing the law actually catching up with practice.
For an individual earning, say, 600,000 per month, if we do, a quick calculation, that will mean, an increase in the PAYE from by 5,000 shillings per month. An effective increase of 0.82% per month. So with this amendment, of course, the disposable income of employees will reduce. If we take into some of the other suggested changes that have come into it, like NSSF, which came into effect, where the NSSF contributions have now increased from the total of the 400 per month employee-employer contributions to now 2,160 per month. That's of course affected employees. This coupled with proposed changes to the NHIF rates, which are being discussed all over the news at the moment. There has been some announcement, and it's also detailed in the regulations. So we wait and see if the maximum contributions will really increase from the 1,700 per month to 13,500 per month. So quite a significant increase. The bill also proposes to introduce a National Housing Development Fund levy. So I'll talk about that in a minute. But if we take all these changes into account, the net, the income of employees will take a significant hit. And the marginal rate of tax, if we take into account statutory and social contributions, will be well over the 35%. So I think it would be good for the government to, really analyze some data to understand the number of Kenyan taxpayers who fall into, the 35% or the 30% bracket, to understand how much more revenue this change will actually generate.
We're also seeing, in terms of expansion of scope, the digital asset tax. So this is a continuation of the KRA trying to look for new sources of income through taxing of sort of digital forms of business. And what does digital asset tax, what are they doing? They're saying you tax 3% on the consideration in respect of any transfer of digital assets. And the digital assets, we're talking about non-fungible tokens and basically cryptocurrencies. And the platform owner would be required to withhold that 3% and remit it to Kenya Revenue Authority. As it is with all these other digital taxes, it's just the impracticality of it. Remember, a lot of these platform owners are probably huge multinationals that are not based in Kenya. They're based based probably in the US or based in someplace else in the world. There are hundreds of thousands of transactions happening on this platform every minute. Are they really going to then start complying with legislation in Kenya just because they would need to identify who is a Kenyan resident, they would need to then register here in Kenya, then they would need to remit the 3%. Now, if you really look at the spirit and if you look at the act, the Income Tax Act doesn't actually tax you on the basis of residency. It taxes you on the basis of carrying out activity in Kenya. So typically speaking, you would not be subject to tax simply because you're engaged in trading on an offshore platform. So this probably goes against the spirit of the Act, which is trying to now tax people on the basis of your citizenship or your residency, rather than the Act, which was looking at taxing activity that's happening within Kenya. So with resolution system. We've also seen the reduction of the rental income tax. This is probably one of the very sort of favorable provisions that we've seen for taxpayers, that has come down from 10% to 7.5%. But the flip side of that is that now you have to pay it within 24 hours. So if my tenant pays, assuming I'm a landlord, pays me my 7.5%, I need to remit that by the next day to the Kenya Revenue Authority. Now, this is obviously very highly impractical, because what they're trying to do here is introduce real-time taxes, and they've done this for the betting industry. But it does work if you have an automated platform, predictable income, and a technology platform below that. Real-time taxes cannot just be applied to any tax, especially taxes that are being done on a manual basis. Tenant pays to be inequitable, if I would use the word. And then withholding tax, something that affects, say, the media, is that, you know, advertising. They've brought back withholding tax on advertising, sales, promotions, and marketing. And this was a provision that they had brought in and was kicked out by Parliament a couple of years ago. It has found itself back in this finance bill. And what the argument was for media owners was that the margins on advertising are very thin. So if you take 5%, it really does affect the cash flow for media owners. And so this is a problematic provision, because it means that what you find is that a lot of media owners then would be in a negative position in cash flow, and advertising is really, you know, the core, the meat of the media business. And